the goal that you're trying to get
Yeah.
to. Would you agree? And that's for me.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end?
What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hello, good afternoon and good evening. If you can see me, if you can hear me, say g'day. Ben, fallen down. Welcome back, Stephen. It's always a pleasure. It's good to have you here for the Rask Invest live show. $1 Million Portfolio, Volume 2. Mr. Leftovers, I saw the Richard White/Owen Rask interview not too long ago and straight away bought WiseTech, now reaping the benefits. Wow, Mr. Leftovers, we will talk about that today, won't we indeed? Now, you might be wondering, why am I not in official Rask merchandise? Well, I've got my Patagonia top on today. My accountant said that that makes it tax deductible. No, he did not, but that would be a good joke. I also do have a Waddle Partners official cap here. I do have a box of toilet paper that was recommended to me by the Honourable Kate Campbell over on Rask's Australian Finance Podcast. This is a kind of like dual purpose Australian brand. You can buy toilet paper online. I'm preparing for the next massive wipeout at the supermarket. But seriously, Rask is going through a rebrand. And so it will maintain the name, but you'll start to see some new things appear in the Rask logo and the way we go about things. In the meantime, if you are a fan of Patagonia clothing, as I always have been, but it's always been too expensive for me, there is a sale on at the moment and it's 40% off. So shout out to Patagonia Australia for that. Andy, good to have you joining us. And by the way, I love that YouTube display picture there. Danny, Marco, reading, Neil. Okay, you can all hear me. Jonathan, Caroline. Wonderful. So today we're going to be talking about the fake news portfolio. And this is a bit of fun if I bring it up here. By the way, the portfolio will be updated via Navexa. You can head to the raskmedia.com.au/live website, where you can also click on these partners that we have here. You'll hear more about them. Obviously, that one is the one that is us at Rask. But all the others, if you click the link, there is a discount attached to them. And we don't benefit from you clicking those links or whatever, but you'll just get a discount. For example, if you click, I think here, they have like a yes message. There you go. So the code automatically applies for Perla. Same for PocketSmith, same for Navexa and all those if you're after some goodies, because these are the tools that I use on the show. There's two more that you're going to see today that I also use regularly. They are not listed here, but I probably should reach out to them and say, hey, do you want to help us with Rask Live? Anyway, you can find the portfolio here on the page. You will remember in the very first installment of the $1 Million Portfolio, we just added one position, which was AAA, and that was our starting position. So you can see this here. If you don't have a Navexa account, that's cool. You can just go to this web page and you can see the portfolio updated in real time. Mike, good to have you with us. I will be adding to the portfolio today. Maybe we can all vote. Is that possible? Is this a democracy? This is the democratic fake news portfolio. Let's have at it. We will discuss today whether it's worth adding any of these positions to our $1 million portfolio. You can see, thanks to the AAA ETF, in 1 month, we have made $694.12. Keep in mind, this is why we call it the fake news portfolio. We had to come up with something fun, is because I also manage a portfolio or portfolios as part of Rask Invest, and I don't want anyone to get confused. Those are the real portfolios, and what we're talking about on the live show is the fake news portfolio. Also, should shout out to Mark and everyone else that had a bit of banter with us over on the Rask community. Mark was suggesting that he might even throw some of his satellite dollars into the fake news portfolio. Where is it? So to single you out, Mark. Oh, it was somewhere else in my feed. I can't remember where it is now. But it was, here we go. Mark's letting us know, and so was Greg. Thank you for commenting and sharing your ideas. It's great. We do love to hear from you. So each and every day, just say good day. Aisha, how are you going? I thought you had a $1 million portfolio, Owen. Well, this portfolio is not real money. This portfolio here, this is real money. This is only 20 grand, but that's just so we could show people what Rask Invest is like. But this one here is purely fake money. So that's something to keep in mind. Justin, good to have you with us. Anyway, I should get back to my slides because I'll just bang on for ages. So Rask Invest Live, this photo comes courtesy of Igor, who took the photo at our Rask event last year in Sydney. God, that was fun. Today's show is brought to you by this Albert Einstein quote, which is, if it's on the internet, then it must be true. That is an actual quote, I believe, from Mr. Einstein. So you can take that one to the bank. But seriously, the reason that we have a bit of fun with this quote this week is because I want you to realize that the fake news portfolio is a bit of fun, and it's how we can talk about stocks and ETFs and funds and weird and wonderful things. But don't take it too seriously, because we do have a disclaimer that applies every week, which is that this show contains general financial information only. So speak to your licensed and trusted financial advisor before acting on the information. I don't know your objectives, your needs, goals, all that sort of stuff. Keep in mind that Rask Invest, if I do mention that thing, is what we call a financial product. It is an investment service. So there is a PDS and target market determination that is available on the website. But when we talk about Rask Invest Live, we're just talking about the live show. But just so you know, for the avoidance of doubt, that is an actual finance thing that's regulated. So I'll take that as read, given that it's been on the screen for quite a while. So the weekly show, the Rask Invest Live show, every Thursday, 12 midday, here on the YouTube channel. We are actually having a race internally on the Rask YouTube channel. Let me just bring this up for you 1 second, really quickly. So when you look at the YouTube channel, we're at a race. I think we only need 10 more subscribers, and we hit 30,000 YouTube subscribers, which is a bit of fun. But we're only about 30 students away from 30,000 people enrolled in our free courses. So that's not the latest counter there, but 30,000 on our mission towards 100,000 in free courses. So I'm just going to put this in the chat. I don't normally put this anywhere, but we are on a mission to enroll 100,000 people in free courses. And thanks to you, we can do that. And it's been amazing. There's courses on everything, including, if you're like today, the course that you might want to know about is this one. If you're a bit more advanced, this used to be a paid course, but now it is free, and it teaches you about valuation. It teaches you about the checklist we're going to talk about today. There is another one, if you're really interested in the deeper side of investing, is the valuation course, which is also free. I think nearly 20,000 people have taken the course, whether it's on YouTube or on the website. And both of them include downloads, valuation templates, Excel spreadsheets. If you're into that sort of a thing, it's yours. So go and check that out. Now, what are we doing today? Well, don't try this at home. The portfolios are for fun. We're going to quickly talk about core and satellite. We're going to jump into the stock checklist, and then we're going to have a talk about some companies. So core and satellite investing, what does that mean, Owen? Well, core and satellite investing is very, very simple, but very, very powerful when it comes to designing your long-term wealth creation. So basically, you build two discrete portfolios, or you have almost like two sides, like two different bedrooms, if you will. One is for low-cost, long-term, more safe style investments, more predictable style investments, stuff that you can sleep at night, or you can go away for a few months and you'll feel fine. Another good way to think about this is the core portfolio should only include things that if you were to pass away, you could give to your partner and they wouldn't have too many headaches. That's what I'm finding, the reason why a lot of retirees are moving out of stocks and out of investment properties and into ETFs for their core portfolio, because it's so much easier. And they can simply just hand the keys, like in their will, across to their kids or to their partner, their trustee of their estate, etc. And it's so much easier for them, and it can keep growing while all that mess is happening. The satellites are where things get a bit fun, and we're going to talk about a few of those potential types of satellite positions today, being some of the stocks. You might have some high risk investments in there. Depending on the size of your wealth, You might even put like private businesses in there. You might put like an investment property. You might put art. You might put like an old custom EH or something like that. It's a bit of fun, but at the same time, it could make money. And it's just a way to break up how you think about wealth. Most people have been brought up on like investment newsletters or reading the AFR, all these types of things, thinking that stocks is the only way to build a portfolio. It's not. So, I hope that makes sense. Okay, so around the outside is what we're going to be talking about a little bit. We're going to talk about one ETF that is going to go in the core. I'm a fan of putting that in the portfolio right now for many reasons I'll explain shortly. Troy says, bring on Monday. Monday's update, can't wait. Yeah, hopefully of the live show on Monday, not to get sidetracked too much, but hopefully the live show on Monday, Troy, which is this one with Mitch, that will talk about all of our portfolio positions. So for those of you that don't know, I do the Rask Invest live show on a Thursday. Mitch does the Monday show, which is more a how-to type session. So that's one where it's like in the nitty-gritty. How do you rebalance a portfolio? I think that was last week or the week before. It's all this one just here. So lump sum investing, these types of things. That's Mitch's jam. I come on once a month and feature with him, but every Thursday you're stuck with me. So sorry about that. Okay, so continuing on. If it comes to picking satellite positions, what can we do? There is this book. Some of you, if anyone has read this, please let me know. I have not read this book, but if someone has read it, like power to you, tell me how it was. This book from Michael Schern, which was written quite a long time ago now. And the book itself is called The Investment Checklist. And I think it's 400 pages of investment checklist stuff. So some of you may know that in 1977, I think it was, Warren Buffett released kind of some insights into how him and Charlie think about investing. It was 4 stock criteria, and then it moved to 5. And so at Rask, for years, we've piggybacked off Buffett's checklist. And so here, for example, you can see how we've interpreted and modernized kind of Buffett's checklist in our own way. But there's a book on it. Just if anyone wants to go back and listen to it or read it, you can there. Morning from WA, Taiwan. Good morning. So if we look and we zoom in, maybe just to make it better for everyone like me that can't see straight. So the companies must have a strong competitive advantage of moat. So we're looking for businesses that have some reason that they're strong, right? Not just it's a goner company, it's going to do this, it's going to do that. Oh, this African mineral resources company is going to do something big. That's just a waste of time. I would never invest in something like that. Number 2 is management must be aligned, talented, transparent, and consider themselves as owner-operators. As we discovered a few weeks ago in our episode on the foundations of investing, so I think that was this episode, the very first one, maybe the second one. As we discussed there, this is the key point when it comes to investing in individual stocks that most people miss, is that you only get the benefit in the stock price of picking a good company after 5 years. So what I mean by that is there's studies that show that if you pick a company to invest in because, hey, it's going to grow its products or services, it's got a better value proposition, its customer service is better, whatever, statistically speaking, it's been shown that it's only from the 5th year onwards that those reasons for owning that stock start to actually determine what the stock price does. Most of the movements that you see in stock prices between now and the next couple of years is actually just due to sentiment changes and what people expect. So it's not actually due to the company changing its business, just what people expect from the business. I hope that makes sense. So when you look at companies, what you want to find are these things, in my opinion. This is just my opinion, of course. Structurally growing and increasingly important industries or sectors. So, for example, you've probably heard the saying that you want to invest where the wind is at your back. A good example of this is you probably want to invest in advertising companies that are advertising on the internet, not companies that are advertising in a newspaper, because the newspaper is dying and the internet is still growing. That's an example. And this right here is actually not from Buffett or Munger. I actually took this idea from another investor called David Gardner, who's the co-founder of the Motley Fool. And I would probably say, potentially, I would describe him as easily the best investor I've ever come across over the last 30 years. So over the last 30 years, his track record, I can't think of anyone who has beaten him or come close, to be honest, to him. So I kind of took a bit of his essence and put it in here, and that's what this is. Number 2 is management must be aligned, transparent, etc., etc. It seems obvious that if you're going to give your money to a company and you're going to let that CEO or board of directors make decisions, that you would want to trust them. So I want to trust them. If I can't trust them, I'm not going to invest. This is a pretty self-explanatory one, but if you invest in a company, I've always believed this, that if you invest in a company, you have to understand what it does. You might not be in control of it, but at least you understand it. So hopefully we talk a bit about that today. And finally, this is the part that stumps everyone, including professionals, in my opinion, is the shares must be reasonably valued. What the data shows is that if you invest for a long time, like 5 years or more, the valuation that you pay is less important than these things right here. These things. These are more important. Number 1 and number 4 are more important than number 5. But if you're one of those people that invest for shorter than that, that's where valuation becomes much more important. Now, a lot of people hear Warren Buffett talk about, investing in Coca-Cola or Apple or these types of things. But then they'll also hear him say things like, oh, valuation is just on a napkin, or I made a decision to make that $10 billion investment based on one meeting with a guy. People struggle to reconcile how he can be such a good investor but not do a lot of valuation. And the answer is pretty simple. He's investing for a very long period of time. So as Charlie Munger once said, the late Charlie Munger once said that it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. So people are obsessed with buying quote unquote cheap stocks. The data suggests it doesn't really work. What does work is buying great companies and letting them grow. The problem is most people can't do that because they can't invest for 5 years or more at one time. They just find a reason to sell. And we covered that a few weeks ago, but that is something that you should definitely keep in mind. So Tarwin, you've made a good point here. You said that you also own WiseTech and agree that the CEO is most interesting, but valuation is the challenge. Yes, very, very much so. Mr. XE Legend says, love your content, started investing and saving my money properly after discovering a podcast you did. Totally set me up for a good financial future. Thanks, mate. Well, that's made my day. I'll drink this coffee to that. Aisha, you make another good comment. Warren Buffett is so firm on understanding businesses and what they do. Absolutely. Put it this way, right? The way I think about it is owning shares is owning a business. So the difference is that you don't run the business. But I think about this. I go down to my cafe most mornings because I work from home. I like to still get out of the house. And when I go down there, I think it's a great cafe. Everyone kind of complains that the coffee is too expensive, but still rock up again the next day. It's a whole thing. Anyway, I think to myself, this business, this cafe, it's a good cafe. It probably does maybe $2 million a year in sales. Maybe more, maybe less. I don't know. But let's say $2 million. If I was to invest in that company, that cafe, I'd probably be giving them $10,000, $20,000, say, as an investment in that company. But I wouldn't control it, right? The key difference is people don't think that they need to understand a business if it's up on their screen, bouncing up and down like a share price. The reality is you should still understand it. You might not know everything. Like I don't know what sauce they put on the chili eggs down at the cafe, but I do know enough to see that there's people coming in, there's people going, people seem to like it, people come back, these types of things. So I think just a level of understanding of any company is vital. Warren Buffett does something that's quite different, actually. Many of you will know that through Berkshire Hathaway, his investment company, he buys companies, but then he never manages them. He's only ever done that, I think, once, where he's actually played a part in managing the business. What he does is he buys them and just let the CEO run it and get out of the way, which is quite an interesting thing. Good response, Tarwin. Stephen, you've said, could you squeeze a property ETF, say 5 to 10% into your call? Yeah, absolutely, Stephen. We can talk about in next month's edition of this segment, we can talk about a property ETF if you want. So just so we're all aware how this works, every month we'll be building this portfolio together, the Rask Invest fake news portfolio. We'll be putting some companies under the microscope, and then we will determine together if they go into the portfolio. We'll track it. We'll put it together for 1 year and then set it free. And then next year we'll do the same again. And we'll just see which ones perform better. And it's a bit of fun and we can learn as we go. And all of you, any one of us can nominate a company. If you just head over to the Rask community page, it's free. And you go to this events tab here and you'll see the upcoming live shows every week. Just click on whichever one. We'll be updating these better in the future so you can see, but just pop a comment in here saying, hey, Owen, can you cover X, Y, Z? Even if it's not a company, you just want to ask a question, you can pop it in there and we'll answer it. So anyway, back to the charts. We're going to look at 5 companies and we're going to keep these ideas in the back of our mind. So competitive advantage, does it have a competitive advantage? Are the management good? Do we understand it? Is it a growing industry? And is it reasonably valued? Now, we're not going to have enough time to go into all of these. Obviously, when my team and I look at companies like this, I'm more likely to spend a month on one company than I am to cover 5 in 45 minutes. And the reason is that I built a core portfolio and managed that portfolio. You just saw it a second ago. I can't remember where it was. But then around the outside, I was chatting to one of our investors this week, great fella. These companies, these satellites, I don't want to own rubbish in there. I'm not going to own garbage companies. If my core portfolio is 80% of my overall portfolio, these are going to be reserved, these seats, if you will, these extra seats around the outside, they're reserved for only the best companies I can possibly find. I am not going to settle for an A or a B+. It has to be an A+. That's the only way it gets in there. And to be honest, why would I bother in creating a headache for myself and buying some cheap stock that I might need to sell and pay tax on? I'd rather just pick the best stock and hold it for 10 years and see what happens. So very high standards is what I mean to say when these companies go in. Isaac, you said, I'm a Wesfarmers shareholder from when the employee share scheme as a Bunnings employee back in the day. That is a good thing, Isaac. I mean, I've never had the privilege of earning equity in a company that I run. So I had to start one and take all the equity and all the stress. But maybe an employee share scheme is the way to go if I had a different life. Fallen down, no worries. Yeah, you can rewatch this later. Anytime we share a link on YouTube, you can rewatch it, mate. So that's no worries. Tarwin, you did say, I'll fess up, I have no idea what WiseTech really does and how it does it. Well, we'll talk about that in a moment. Okay, so we're going to talk about Wesfarmers. We're going to talk about Home Depot, Costco, WiseTech, and at the end, we'll sneak in a little bit of bond ETFs. So let's talk about the first one. I want to ask y'all a question as we begin this foray. Can you please tell me if you think Bunnings Warehouse, for any overseas viewers, maybe Andy, you'd know what Bunnings is, Bunnings Warehouse. Look at that, I can spell. Here we go. Tell me if you think Bunnings Warehouse has a competitive advantage. And if so, why? I would love to know what you think about this. Do you think it has a competitive advantage? It's better than the competition. If so, why? And while you're musing over that, I'll just read this comment from Isaac again. I'm a Wesfarmers shareholder as an ex-Bunnings employee, so I don't really have a thesis as to why I have the shares. Any ideas on forming a thesis when you don't have one? Absolutely, Isaac. You can form a thesis. So the idea of a thesis, while people are getting their responses in, the idea of forming a thesis is basically to take a checklist, run a company through that checklist, and then let that inform your reason for owning it. So you go through, you answer these questions honestly to yourself, because you're the only one that's going to find out if you're lying to yourself. It's your money too, by the way. you go through, you answer these questions, and then you use that as the kind of the reason that you hang on to these shares. And if you want to know more about that, mate, just enroll in one of our free courses. They're actually, to be honest, they're pretty good, and they're free. So there's two courses that are paid on our education side. I'll just quickly show you which ones those are, so you don't have to click on them. So the two courses that are paid are the one that Queenie has created, Queenie Tan, the wonderful, on our website, and this one, which is $499. Everything else is free and must go. So go and enroll in them, and there's heaps of, particularly the investing ones, will teach you exactly how to create a thesis. Okay, so Caroline, you have hit the nail straight on the head. You have said that Bunnings' competitive advantage is its sausage sizzles. And I would agree with you. The reason that anyone should buy Wesfarmers shares right now is for the sausage sizzles. But isn't that hilarious? That's the thing that most of us would know, right? Is that Bunnings, the former chair, Richard Goyder, is the one who thought, let's do a sausage sizzle and let's do the charities and the local schools and local sports clubs. Let them do it. And we'll just give them the barbecue and give them the gas and give them everything they need, and then they can go and raise money. What a wonderful thing that is. So if you like sausage and bread, get down and support your local. Okay, so, yeah. And Marco also said the same thing. Glenn said the same thing. So we all know exactly what the real reason is that you would buy Bunnings Warehouse, and that's for sausages. Andy over in NZ, you said Bunnings is strong in New Zealand for sure. That's good to know. Dean said it's largest home retail building supply company. Yes, another competitive advantage is credibility. That's interesting, Glenn. Why do you say that? Why do you say that, my friend? I would like to know. Okay, so do Wesfarmers have a whole or direct competitor? So this is a good question. So I believe that Wesfarmers has an extremely strong competitive advantage in Bunnings Warehouse. So Wesfarmers owns Bunnings Warehouse. Wesfarmers has been around for, I think, over 100 years now, but they actually only bought Bunnings in the 70s. And at the time, it was quite a small franchise, and they've rolled it out everywhere. There are competitors. So we know Bunnings as, for most of us that aren't tradies, we know Bunnings as the place where you go and get stuff for the house, like to fix a wall, to maybe even for the garden and whatever. However, there are very, very strong competitors, and they're typically localized competitors for trades. So it's the DIY market where Bunnings has its competitive advantage, not so much on the professional side. There is a Bunnings trade, and they are investing a lot of money in that to try and improve its credibility. But for the most part, most of us, it's just a DIYers type shop. There are competitors like Mitre 10, Home Timber and Hardware, and Bowens. For those of you that are familiar, those tend to be some brand names that people recognize. But since Masters was shut down by Woolworths and Lowe's, the American company that owned it, quite a few years ago, basically it has no genuine competitor here in Australia. Hence the reason that it is so successful. Glenn, you followed up with your comment from before saying they seem to have staff that can advise the DIY, they host workshops, etc. Issue said, I personally think Bluey from the marketing as Bluey is global. Yeah. CL's Travel, you said, do Wesfarmers have, so the competitor would have been Masters. But basically, Isaac, you said Bunnings has competitors with places like Aldi in the mobile section specials and local specials nurseries. Yeah. So basically what happens, Isaac, and you'd know this just probably better than I do, is there are particular areas where Bunnings is competing. But one of the reasons that Bunnings was able to fight off Masters so well was because Bunnings stocked good merchandise, right? It stocked, if you wanted, I don't know, a Milwaukee drill, yeah, you could go to Total Tools, probably get a better one for slightly more. But if you wanted a Milwaukee drill, you had to go to Bunnings. You couldn't go to Masters. If you wanted, I don't know, some type of lawnmower, you had to go to Bunnings because Bunnings formed the relationships with the suppliers. It had better merchandise on the shelf. Therefore, it attracted the right customers. That is one of the kind of hidden reasons why Wesfarmers / Bunnings was able to do that. Now I want to ask you all another question. So on the page in front of you here, what you can see is Wesfarmers, which is what we would call a conglomerate because it has all these other businesses inside it. What you can see, I'll zoom in a tad, so I don't even need to put my eyeballs right up to the camera. Here you can see all of the different businesses, right? This is the sales or revenue that are generated. So Bunnings creates 43% of the sales, but from a profit perspective, it creates 60% of the profits, right? Kmart is 25% of the sales and 25% of the profits. So what these two different numbers tell you, I'll get out my Mr. Squiggle right here. What these two numbers tell you, if this one right here is smaller, but over here it's bigger, what that tells you is Bunnings has a better profit margin because every amount of sales that come through is turned into more profit. Whereas with Kmart, you can see it does a lot in sales, $11 billion of sales, but only $958 million of profits. And this is just profit by business unit, for those of you that are confused about that. So I want to ask you another question. Higher gross margin, says Dean. Hit the nail right on the head. Why do you think, why do you think? Do you think Kmart has a competitive advantage? If so, better or worse than Bunnings? So does Kmart have a competitive advantage? Yes or no? And while you do that, I'll have another sip of my, it's just an espresso, by the way. I don't really have coffee after 1 p.m. So I got to get my fill somehow. Tarwin, you say Wesfarmers is a conglomerate. In the ASX, it would compare to maybe Seven West Media or Sol Pattinson. Good point. Okay. So while everyone is now answering that question about Kmart's potential competitive advantage, Rob says no. I want to just look around the room here, and I would encourage you to look around the room where you are. Just have a look around the room and look at all the different things that are in here. Obviously, there's a big box of toilet paper from Yarn. There's a bunch of books there. There's a Dyson vacuum over there. There's a couple of these lights. There is a mouse from Apple, phone from Apple. There is a literal apple. What are the chances? Maybe that thing over there. Anyway, so everyone said no. They said it's much worse than Bunnings. There are retailers doing similar things, says Dean. WH says yes. Kmart has low prices. Rose says Kmart has a competitive advantage relative to the market it operates in. These are all good points. So I would say that it probably has a competitive advantage. It just wouldn't be very strong. So it's a competitive advantage that is not that strong. And one of the ways you can tell is if you look around the room and see all of these things could be available, for me at least, at Kmart, but I bought none of them from Kmart. These lights came from Amazon. Everything in this room comes from a different retailer other than Kmart. I bought that Dyson at the Good Guys. It was on special. What a great deal. I bought this jumper from an online store. And so my point is that it is actually in a very competitive industry. Now, if y'all want to dive deeper into how to analyze a company's competitive advantage, where's the free one? This one. I think it's this one. In this free course, there's a thing here, understanding moats, and in particular, I think it was this first one. Can you spot the moat? I'll actually just log in to show you what that actually looked like. But basically, there is a tool that you can use. Don't copy my password, please. So there is a tool that you can use, and it's called Porter's 5 Forces. It's actually one of the books behind me. I think it might be this one, actually, come to think of it. No. Geez, look at that chart. It's a good-looking chart. No. Okay, it's not here. It'll be somewhere in this course. But basically, my point is you can use a tool called Porter's 5 Forces. This is a really popular tool for analyzing different companies and how they sit relative to their competitors. And there's this, geez, what's with all these pop-ups and weird ads, Investopedia? Okay, so they don't actually show the chart that I wanted to. That's the most valuable thing for everyone here, which is, this is a good example of it here. It shows you that when you have a business, it doesn't matter what business it is, you can look at it from the perspective of all the different stakeholders. So for example, if you put Kmart in the middle, let's see if we can blow this up a bit. Can I make that bigger? Here we go. If we put Kmart in the middle here and we said, what is the competition amongst the existing competitors? It's very high. They obviously even closed down their Target business because it was cannibalizing, or Kmart was cannibalizing one of its existing businesses. But there's like Amazon, there's a bunch of new existing competitors. What about new threats? Threats from new competitors. I can't think of too many competitors that have entered the space recently, but there are a lot of businesses around the outside like JB Hi-Fi, Harvey Norman, different businesses that are kind of there that could try and offer similar services, but probably not as well as Big W and those types of things. Could you substitute products from Kmart? Yeah, probably. You know, if there's a really interesting thing in the US, comes out from David Gardner as well. So I'll bring the screen back up. Companies that pass the SNAP test. So you can see that there. So I'm going to just turn off my screen for a second and come back to you. So when you snap your fingers like this test by David Gardner goes like this. If you snapped your fingers and a company disappeared, would you care? Would you notice? Would anyone care or would they notice? Now with Kmart, if I snapped my fingers and it disappeared, would people notice? Absolutely. Would they care? Yeah, probably. But would they care that much? Probably not, because they could use Amazon, they could use a competitor's Big W, like most country towns only have a Big W or a Kmart. And that's a good example of a substitution. It doesn't really matter where you get your $5 jocks from. It doesn't really matter. So that's an important consideration to keep in mind. The next one down here is bargaining power of buyers. So this is where if you have a business and you would be bargaining with Kmart, obviously we can't do that. Bargaining power of suppliers. So this is the power of the companies that supply all the products to Kmart. What power, do they have? Aisha, you said you would cry if Kmart disappeared. You probably would. I would probably be upset, let's be honest. But at the same time, could we find another way to get our products and services? Probably. Now, this is not saying that it's going to happen. It's just a reality. Now, for example, Aisha, imagine that, I don't know what kind of phone you use, but imagine if we do the snap test again, and this time Apple disappears. Or this time Telstra disappears and you have to go to Optus. Snap your fingers again. This time, let's say Bunnings disappears. This time, let's say, I don't know, Google disappears. Keep going again and again and again. And every time you snap your fingers, imagine a different company disappears. And every time you will find out which companies are more important to you. And so I think that's one of the things. So Marco's done the Chat GPT thing, and he said, this is what Chat GPT says. Cost leadership, strong brand recognition, excellent store, sort of efficient supply chain, strong pipeline. Aisha says she uses an Oppo. Well, there you go. Oppo, there you go. So KFC disappears. Trung, would that be good or bad? So tell me about this. I can go to Big W if Kmart is gone, says Peter. And that's my point, right? What you can't go to, you don't go to a competitor of Bunnings. So if you don't want to remember any of the finance stuff that people tell you about competitive advantage, just remember that the key thing that matters is actually not that all these widgets and numbers and crap like that. It's actually, will customers pay more for the service? And we pay more at Bunnings because it's the only one and because it has the products that we need. So it is good at what it does. And it's effectively a monopoly on the DIY market. There are alternatives, and the government and the ACCC would say, oh yeah, you can go to Bunnings or you can go to your local go to Bowen's or you insert other brand. But the reality is that's the big dog. So if we look across all of Wesfarmers, we see that most of the business is Bunnings, hence why we spent so much time on that. Kmart is a good business, not a great business. The chemicals, fertilizers business is actually really strong. Industrial safety is actually a really strong business, but it's just not at the same scale as Bunnings. So if you were to buy Wesfarmers shares today, let's say you logged into Perla and you bought your Wesfarmers shares. There we go. Let's say you log in. It doesn't really matter if whatever investing platform you use, by the way, but definitely philosophically aligned to Perla. If you logged in and you bought shares today, right? What you're basically getting is Bunnings plus a bit of some other stuff. It'd be like buying, you go down and you buy a pie from the bakery. You're getting 60% Bunnings in that pie, but there's some other stuff thrown in. It's a bit of a funky mix, but basically that adds diversification. And Wesfarmers as a whole has done a really good job of growing its business. So let's just talk quickly about some valuation stuff before we move on to the next example. We'll spend less time on Home Depot because we're not always familiar with it. So this tool that I've just started using, I did get some questions about this in the Rask community the other day. And shout out to Rob, who has found an alternative, which we might also feature on the program in the next few months. But let's say this is a tool, this thing Ticker, T-I-K-R, I think it starts at about $15 a month. And the reason that you would use it is because it has better data than your traditional stockbroker like platform. Another thing you can do with it is if you click on Track Investing Gurus, you can actually use this to track some of the biggest US investors. So for example, we mentioned Berkshire Hathaway, which is Warren Buffett's company. You can see based on the latest legal filings that Berkshire had to make, you can see what they own. We talked about this a little while ago. They sold a huge amount of their Apple shares, massive amount of their Apple shares not too long ago. That was about a month ago, you might remember, when the stock market looked like it was plummeting because of something that happened in Japan and everyone freaked out. That was exactly the time that it was revealed that this happened. But yeah, anyway, he wasn't trying to pick up the market. Another one some of you might be investing in or hearing about is Kathy Wood and her investment business called ARK. And you can see how much she has invested in Tesla, Coinbase, Roku, Block or Afterpay, Roblox, etc. Kind of this like real strong growth investor. But anyway, if we go back to why we're using it today, we're actually using it to understand a bit more about Wesfarmers. And we'll wait for this to rock up. It's not doing it. So let's quickly switch gears. Let's go to a different stock and then back to Wesfarmers so it plays with us. One of the things that we can do is we can look at this valuation tab here and we can have a look at it over time. If we go right back in time and let's say we want to look at the dividend yield of Wesfarmers through time. Now, obviously, a higher dividend yield is better, right? Because it means that you're getting a stock cheaper. The reason that I'm looking at dividend yield with Wesfarmers is because it's a big, mature company. You wouldn't look at dividend yields for a small growth company. But for a larger company that pays a very consistent dividend, you can use it as a way to understand if this company is expensive or not. And you can see here that over time, Wesfarmers, it used to have a much higher dividend yield before people realized how amazing it was. But what's happened is as people have realized how good it is, they paid more and more for the shares. And you can see the average dividend yield over time, at least for the last 5 years, has been around 3%, which for those of you that are kind of familiar with this idea, you can get a term deposit that offers you 5% interest. So then you've got to ask the question, why would people buy this company at 3% dividend yield when they can just put their money in the bank for 5%? And obviously it's for the long-term growth. So I'll leave this with you here, but what it basically looks at, this chart, is it's slightly expensive, or it's probably more expensive than it was historically. But a great company, this is the key thing, a great company is rarely on sale. ResMed was probably the only one that I could think of last year that went on sale. Everyone was scared about Ozempic and all that sort of stuff. But ResMed is a great healthcare company. We can talk about this next month in a different show, but you don't often get the chance to buy a great company for a cheap price, which if we go back to Charlie Munger's quote, buying a wonderful company at a fair price is probably the best you can get. You don't often get a wonderful company at a wonderful valuation. But let's just go price to sales. Everyone was scared that Ozempic would take away the the ability for ResMed to sell its CPAP machines for sleep apnea. And obviously you can see how wrong everyone was. They sold it off as the GLP-1s and Ozempic and stuff came in. But then everyone realized, hold on a second, ResMed's one of the greatest companies Australia has ever seen. Let's just buy it. So you can see that the valuation dipped there. And that was a good buying opportunity. Anyway, let's move on because we'll spend a little bit of time on Home Depot. And now Home Depot is effectively the big brother of Wesfarmers, or Bunnings. So if we look at Wesfarmers, it's an Australian company. Oh, look, our article's up there. If you look here, $79 billion is the total market cap, the total valuation of Wesfarmers, according to the gods at Google. So if we look at Home Depot, this is in US dollars, is $362 billion. So I'm not in the business of quick math, but if I was, I'd say it's about 6 times bigger in US dollars. You add on the US dollars, it's probably more like 10 times the size. Maybe not 10, maybe 8 times the size of Bunnings. And why? Probably because the US economy is 10 times the size of the Australian economy. There's 10 times the people and all that sort of stuff. So it can have more stores. So this is Home Depot. For those of you that don't know, just to really cement the imagery in your mind, if we go images, you can see it's basically the same thing, except they have a bit more pride and they put a US flag on top. Bunnings does not put an Australian flag on top, which is a shame in my opinion. But you can see here, it's basically selling the same stuff. They're just wearing orange instead of green and red. So let's talk a little bit about this company. One thing that Home Depot does, and all US companies do, by the way, is if you go to their website, they report quarterly earnings. So you might hear like analysts say, like, this quarter something happened. In Australia, we don't do that. We do it for very, very small companies. They're legally obliged. If they're very small in Australia, they have to give us quarterly earnings. For those of you that are just starting out, what does earnings mean? Earnings is the US version of profit. So anytime you see quarterly earnings, just interpret that as 3 months profit, and they do a report for that. They call it earnings. It can sometimes be called income, net profit, whatever. But earnings, profit, same difference, if that makes sense. So anyway, I can see. We will have a recording of this. Yes, still working. Yes, that's right, Guru. We definitely will. So what you want to look for when you look at a US company, you can go to the annual reports section, see this up the top here. But what you really want to look for is something called the 10K, which is just here. And basically, if we click on 2023 here, you can see that you've got quarterly results. If you go up and you click on annual results, you can see this annual reports. But notice how there's no 2024 one. That's because we haven't got it yet. Aisha, you said, wasn't a business recently removed from the ASX for not reporting earnings? That's good. You're up to date with current things, Aisha. Yes, absolutely. So that was Star Entertainment Group, the gambling company from New South Wales. It wasn't removed. It was just suspended, is my understanding. So you can see that it's a horror show for Star because of the whole licensing, gambling, blah, 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 blah. This actually happens quite regularly, but it doesn't normally happen for such a big company, $1.2 billion. Often it happens down the smaller end where all the shonky companies are, not the big ones like this. It's also shonky, let's be honest, but it's a bigger shonky one. So back to Home Depot. When you look at the reports, you're looking for the 10K. And one of the things that Home Depot does is it tells us a bit about its business in this, what it calls an infographic. So every 3 months it shares this, and we can see sales growth of only 0.6%. It's positive though, that's going in the right direction. On a comparable basis, down. When we look at, where is it? The number of stores, it's got 2,019 in the US, 82 in Canada, and 139 in Mexico. And you can see some of the things here that it says. But if you go into the 10K report, this is the key thing, 10K report, you search for something called segment report. So I'm on a Mac, so I could press Command F. If you're on PC, you could press Control F. Segment report, you can see it here. This is a legal requirement for Australian and US companies So you can see it here. If you click on that, bada bing, bada boom, what you get is somewhere deep down in this PDF, you get something called a segment report. This is, if you're new to reading an annual report and you are overwhelmed or you don't have the time, just go to this part of the annual report or 10K and it tells you more about the business. So a lot of people are confused. They're like, oh, I know it's Bunnings, but what does it actually do? Or what I know it's Wesfarmers, or what does it actually do? Here is where they actually tell you exactly what products and services they are selling and how they think about it in their minds. And here you can see they say that there are 3 major types of products that Home Depot sells. We've got building materials, which includes like electrical, lumber/timber, millwork, plumbing, whatever. Decor, so appliances, kitchen and blinds, etc. And it's got hard lines, which you call like indoor gardening, outdoor gardening, storage, and organization. So more stuff that you'd find at Kmart kind of thing. And you can see how the business is performing based on those different businesses over time. And you can also see like the total. And the business went backwards is what we mean to say. So would you buy a business that's going backwards? Well, maybe, because even though it has competitors like Walmart, Amazon, different types of businesses, there's many different types of businesses that work in this space in the US, unlike Australia. It is a wonderful business. And the reason that I wanted to talk about Home Depot and Wesfarmers together is so you can see the differences in the data. So let's have a look at Wesfarmers. And what we'll do is we'll go to this financials tab here and we'll look at something called the gross profit margin, which Dean brought up before. So this is comparing the profit that they earn on selling a product. So let's say you go and you buy a drill from Bunnings, and let's say you pay $100, but it only costs Wesfarmers $80 or Bunnings $80. That's a 20% gross margin. But what we can do is we can now compare Wesfarmers to, say, Home Depot, and we can see over time how have these two businesses fared. So let's make it a column chart, and you can see, unsurprisingly, that over time, both of these businesses have really, really similar profit margins. Wesfarmers and Home Depot, very, very similar. This is eerily similar, if you ask me. Eerily similar. And that's because they're eerily similar businesses. So you can see here, obviously, Wesfarmers is weighed down by Kmart, but you could say the same for Home Depot. It's weighed down by its other divisions and the stuff that it sells. Owen, do you think the financials in Yahoo Finance are reasonably accurate? No, is the answer to Owen. The reason that I use Ticker is because it's probably the cheapest but best data that you can get. I don't use data from any stockbroking account because it's often an afterthought for the stockbroking account. That's why I use Ticker. In fact, if you, say, invested with us at Rask Invest or you invested via Pearly, you don't even need to log in to place your trades. And that's what makes them so powerful. Whereas, so I rarely log into my brokerage account, maybe a few times a year, if that, even though I'm investing, right? I just don't need to log in. I can just send my money and it invests in the things automated. But when it comes to data, I always go to like a third-party resource. In this case, it's Ticker for companies, but I'll introduce you to another one in just a sec. I'm going to speed up a bit, guys, because I'm running way behind. But, okay, so if I put it to everyone here that's watching, and we're going to make a decision right now. Let's say in our portfolio, in our fake news portfolio inside Navexa, of this $1 million, let's say we're going to put $50,000 to work, ladies and gentlemen. We're going to put 50,000 clams of our fake clams into an investment. I want you to tell me how much of those clams would you put into Wesfarmers and how much would you put into Home Depot? All we're going to do is you just tell me there's 50,000. You could say, I want to put 25 and 25. I want to put it all in Wesfarmers. I want to put it all in Home Depot. I'm just curious to understand what you think. And when you get your responses in, we'll kind of put them all together and we'll make a decision. You might even say none. Don't buy either of them. They're a waste of time. Let me know what you think. Chuck it in the chat and we'll go from there. But needless to say, both of these companies have very similar competitive advantages. They're both the biggest in their industry. They sell an essential services. They benefit from selling the best brands. They benefit from people spending more on their properties. Remember last week we talked about property. We talked about last week, we also talked about why you might remember we had that Paul Clitheroe video where he said every little person is an economic miracle. These companies benefit directly from there being more people who need more housing, who spend more on things that they need for those houses. So these are two companies that capture a lot of value. So need to get an idea of valuation first. Yes, Tarwin, that is fair enough. Caroline, does Wesfarmers offer franking credits? It absolutely does, Caroline. Aisha's saying 30K in Wesfarmers, 20K in Home Depot. TC saying 30K in Wesfarmers, 20K into Home Depot. Dean is saying, what's Dean saying? 50K into Wesfarmers, 50-50 Marco, Plant 1, 15 into Wes. More in franking credit, more into Wesfarmers for the franking credits. Ray spinning it around saying 40 into HD, 10 Wes. Or Wes, says Kylie. Okay, so it seems like the consensus, even though there were some minor disagreements, is more into Wesfarmers. So let's do that. Let's go 30-20. I'll kind of split down the middle. And again, we haven't talked about valuation in any great depth, but we just need to add some things to this portfolio. So let's add some stuff. Let's get some stuff in here. Let's go, I'll zoom in so you can all see. Let's go Home Depot, and we're going to put the equivalent. We'll just take whatever the stock price was. So the share price, what are you giving us? This is the exchange rate. So let's say we got, of our 50 grand, we're going to put 20 in. So I'm just doing the quick math. We're saying 55 shares approximately. There's no brokerage cost because we're absolute legends. Whoop, I've done too many. Let's go 35. How are we looking? That's closer to it. We'll go 36. Now, if you had your brokerage account set up with Navexa, obviously this would automatically happen. This whole thing gets automatically filled out. It's for your tax reporting. So boom, well, we're going to do one more, 37. That gives us a $20,000 position. We are in the fake news portfolio, ladies and gentlemen. Let's add another holding. We're going to go Wesfarmers. We're going to go Wesfarmers for 30. There we go. So it's 69.69. So let's take 30 grand. That gives us about 428 shares by my calculation. There we go. And no brokerage cost because we're friends with the broker. So if we go to the portfolio, now, ladies and gentlemen, we can see our positions. Would you look at that? We've already lost money. Great. Oh, no, that's just the price. Whew. Okay. Now, what tax implications are there with investing in the US, says Lewis or Louis? Yes, there is a heap. So this is a fake portfolio. There are withholding taxes that apply. So if you invest in anything in the United States from Australia, you will need to fill in something called the W8 Ben form. And that is the thing. So we talked about this last week's show where we talked about the week before, investing in US stocks from Australia. I'm not a big fan of investing in US stocks from Australia, by the way, but for the purposes of this fake news portfolio, we shall do that. So that's in the portfolio. Now, let's quickly talk about Costco. Unlike Home Depot, Costco is actually growing faster. It is actually growing well. So if we look at the different sources of revenue, we've got the total down the end here, right there. Look at that, ladies and gentlemen. It's actually growing fast. And if we go into, I can get out of the Home Depot stuff now, just for simplicity, get out of the Morningstar stuff, and we go to Costco. If we go to its income statement, I think I had that here. Yeah, here. What we can see is that Costco makes a lot of its money, not just from selling things, but also from its memberships. I'm a member of Costco. In fact, look at this. I was looking for some props before. This is my, what is it? This is my salad topper from Costco. It's 1.2 kilograms of salad topping. I don't eat that much salad, but when I do, I need 1.2 kilos of it. This was the smallest size they had. So that's why you go to Costco. Tarwin says it goes there for toilet paper. Anyway, so I pay for the right to go to Costco because I know that they have really good brands. It's good value. It's not cheap. It's good value. You get good brands there. It's kind of like shopping at Bunnings in some respects, although Bunnings quality has gone down a bit. Aisha, you've said, I recently read Costco is doing even better since they have started stocking gold and selling it for $2,359. Probably. They also have optometrists. They have all types of things inside of Costco, as well as brilliant hot dog and drinks. I once heard a story of the founder, Jim Senegal, who once responded to the chief financial officer, because you can get a $2 hot dog plus drink at Costco. The CFO comes in and says, Jim, we need to push up the price of the Costco hot dog. And he said, because he said, it's not profitable for us. It's costing us too much. And he turned to him and said, if you put up the price of the hot dog, I will kill you. And then that meeting was done. And that's a view of how important it is for Costco to keep prices down. QA, just reflecting on something you said here, you would put $50,000 in Wesfarmers and none in Home Depot just to avoid the taxes. Do they still sell coffins at Costco? Absolutely, they do, Marco, on the way out. Just after you finish your hot dog and your heart starts seizing up, you can look at the coffins. But interestingly, people think that Costco is unable to grow because of online and all these types of things. It is growing fast. It's growing around the world. It's got more members than ever. It's got all of these different things. And it's a wonderful business. And I actually think it's one of the highest quality businesses in the world. And if it's good enough for Charlie Munger, it's good enough for me. Costco was one of the only businesses, if not the only business other than Berkshire Hathaway, that Charlie Munger sat on the board of. And he was invested in it. Charlie Munger once said that he read Barron's newspaper. It's like a publication, I should say, for 50 years, and he got 2 stock ideas from it. He read it for 50 years, and he got 2 stock ideas. That's the type of guy that Charlie Munger was. Very, 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 very picky. One of the investments he made was with Li Lu in China. The other one was Costco, I believe. So, Dean, you're saying, are these results for Costco worldwide or US? So here, Dean, you can see that this is the United States, this is Canada, and we're over in Australia. We're in this bucket right here, if that makes sense. Yeah, Costco online shopping has some great exclusive deals. Yeah. Tarwin, you said, thanks for reminding me to go to Costco and buy more salad topper. Jocks there are good too. They are. To be honest, they are very good. Okay, so let's keep moving on. I would, given that it's a fake news portfolio, I'm kind of in love with the Costco brand and the Costco business, but there are some risks to it, like profit margins and these types of stuff. I would love to have it in our fake portfolio, but I'll let you all decide that. Let's move on to the thing that people most want to know about. If you Google Richard White WiseTech, which is the name of the founder of WiseTech, Richard White WiseTech, there we go. Look at that. There's an interview with him on the Rask network, which I'm very proud to say was a wonderful discussion. I'll put that in the chat now. So Richard founded WiseTech, and it was a business. He had started other businesses, like an audio and lighting business, and he's incredibly scientifically minded when it comes to things like mathematics, engineering, industrial engineering, these types of things. And WiseTech was kind of like his third business, and it's just grown and grown and grown. So Tarwin asked, he said before, I don't actually know what it does, but I was just so convinced after listening to this. That's, by the way, that's not the reason that I do those interviews with people. I don't do them so people just go and invest in them. Some of the people that come on our shows, I wouldn't invest with because it's just not how I do it. But I bring it up because it is a great business. It is he's a wonderful CEO and steward of this business for a long time. So what does WiseTech actually do? So WiseTech sells software for the logistics industry. So this would be like, when you go past the shipping yards and you see the big names of shipping companies on the side of the shipping containers, those types of businesses would buy the software that we're talking about. And when a product or something goes from, say, Europe to Australia or from China to the US, it needs to be tracked and it needs to go through customs. It needs to meet the port authority. It needs to do all these different things, pay taxes, whatever. You can handle all of that with the CargoWise One software. That's what it does, and that's how it works. So if we click here, get out of this. So you can see the business handles all of these different types of things. So Toll might be a customer. Yes, that's the type of business. Now, they say in the most recent update from WiseTech, they actually say that the names of some of the customers, which many of you might be familiar with in terms of some of the big customers they landed. So we've got the business Sinotrans, which you probably see around. You just don't really think of it as a company that's interesting. APL Logistics, TIBA, Grupo, Yamato, I should pronounce that correctly. But the other one is Nippon Express. Some of you may have seen this. This is one of the biggest freight forwarding companies in the world, and it's Japan's largest. You may have seen this around, you may not have, but this is an example of the type of business that would use its software. But the way WiseTech has grown historically is probably one of the most interesting for ASX investors, because the way it has grown is two different ways. And I'll just get to the slide. I think it might be right at the back, actually, that I wanted. Let me. Oh no, it's not in this pack. Sorry. Okay, we'll just stick with this. This is my favorite chart from WiseTech, but I'll say this in a different way. So let's keep that there and let's go back here. So when we look at WiseTech, it sells software on a subscription, kind of like Microsoft 365 or Office or whatever you use, Apple, iCloud, these types of things. Tarwin, got to go. No worries, mate. Thanks for tuning in today. It's good to see you. So we look at the business, right? And we can see if we look, 96% and 97% of its subscription revenue is recurring. So what it's basically saying here is most customers come, use our software, and never leave. And that's because the software does its job and it's really hard to give up. It's sticky, right? And so you can see that there. 97% of the customers last year are paying this year. If we go down, we can see that the profit margins are absolutely amazing here. So $262 million of net profit on only $1 billion of revenue. That's saying that's about, 26%. So that's really, really good. It pays a very small dividend, nothing to write home about, but that's not why you would buy this business. It's a profitable, sticky software business. And that's effectively why so many people have fallen in love with WiseTech. It's because when it gets a customer, it never gives them up. And that's because they can't give it up because the software is so good. And you can see that played out in this chart here, which is that what it shows you in different colors is the different cohorts of customers. So in this lightest shade of blue, right back here in 2015, what it's saying is all the customers that we got that year, how much are they paying today? So if we look up here, they're paying this much today, but they've been with us since 2015 or earlier. So as customers use the software more and more and more and more and more, they pay more and more and more and more and more, and they never leave. So it's kind of like a big vacuum that just sucks in all of these logistics companies and says, use our software and keep growing. So that's the first way. The second way that they grow is they acquire other businesses and acquire their customers as they do it. So they go to, say, Italy, and there's a particular software company operating in logistics in Italy, and WiseTech says to themselves, well, we could go and try and build our own software and compete against that player, or we'll just go and buy them. And then we've got their customers and we get them to use our software. And that's what they do. So there's this acquisition model as well as this long-term organic growth model. And you can see that play out in WiseTech's, financials over time. So if we jump in here and we just look at the sales of this business through time, or revenue at the very top, or we'll go total revenue just here like that. And we go since it was on the stock market. Look at that. Look at that revenue taking off. And if we want to add to that, let's say we want to add, we'll go gross profit margins because that's what we looked at before. We can see, whereas Home Depot and what was the other one? Wesfarmers had profit margins of about 30%. WiseTech has profit margins of about 85%, which is amazing. So if you have really fast growing revenue and you have strong profit margins that you can maintain, effectively what you're getting is you're getting a lot of profit because you're growing and you're taking more of that growth as you grow. And that's what makes this business so wonderful. And it's why it's one of the biggest companies in Australia already. And most people don't know about it because it does something that's confusing to most people, but it's a wonderful, wonderful business. And it's actually the strongest performing company in share price over the last few months from Australia's blue chips. This is, in my opinion, Australia's future blue chip. This is the company, or one of the types of companies, it doesn't have to be this one specifically, that in 10 or 20 years, we're going to be saying, instead of, Commonwealth Bank, we're going to be saying WiseTech was up today on the stock market. WiseTech was down today on the stock market. Percy, you've just entered the chat. What platform I'm using. This is the ticker terminal, TIKR. I think it starts at about, I think it's like a freemium version, it's like a free version, and then it's like $20 or something like that. But anyway, you can see this here. Another thing you can do if you want it to be really sneaky or cheeky, it's not sneaky, is you go down to here where it's got call transcripts. So these are like you could say like this thing here. So let's say this is the call that happened recently with the CEO and the team. Let's say we got this here. This is the financial results. All right, let's just grab that. Let's pop this into ChatGPT. Let's go. Can you summarize this into 3 key points? Boom. Let's see what it says. So it's given us the 3 key points from the recent financial results. It said had strong financial performance, strong recurring revenue, growth drivers, and outlook. Okay, cool. Can you give me the weaknesses? Let's see what it says. There you go. So it looks like there's been a bit of margin dilution, increased depreciation, and there's some debt and financing costs, but they're bugger all. Good old ChatGPT doing a half-baked job for us, but that's okay. So you can use that tool, Percy, in weird and wonderful ways, is what I mean to say. So, any case, why don't more people buy this business? And I've kind of left this blank here. And the answer is also shown in Ticker. If we go back, you could do this in any software, but let's just use Ticker. Not any software, but let's have a look. The reason is that most people see this share price going up and they're like, this is not the share price, but they see this valuation going up and they're like, that is wild. This company is so expensive. Why would I buy it now? In fact, WiseTech is at the most expensive point, it looks like, in its entire history. If you were to buy shares today, it is the most expensive time in its history to buy shares. So a lot of people are getting spooked. And I've spoken to a lot of investors who have owned shares from the early days, like way back here. And they're trying to sell out. Aisha, you've said, what about ProMedicus? Cam, you've said up 45% in a month. Geez, yes, that's a good question. One more question: alpha spread versus ticker. Percy, I do not know alpha spread. I've used ticker for a few years. I've used quite a few, but I've never used alpha spread, so I can't comment. Sorry, friend. But with this one, back to WiseTech, it's incredibly expensive. I'm the type of person, even though I teach the Value Investor program, I'm the type of person, because I use a core and satellite approach to my investing like this, and I'm a really long-term investor, I put valuation last on my list of things that I look at, because for me, valuation is important. But if you're a long-term investor, it's not the first thing you should look at. It still bamboozles me today that when people look at a company that they're going to buy, that they can hold 2 opinions in their mind. They can say, I'm a long-term investor, and then the first thing they believe is, let's look at the valuation. That does not make sense to me, because if you actually understand the maths and what actually happens in the stock market, valuation isn't the most important thing. What is more important are these other things that we've spoken about. Like when you actually do it long enough, you realize that those are the important things. Valuation is important, but it's not as important as the finance industry would make it out. And because of the way that I invest in a core and satellite approach, when it comes to valuation, instead of looking at it and being like, oh, it's too expensive for me to buy, what I tend to do is a bit of a different thing, is I don't go, oh, it's too expensive to buy. I might just say, instead of buying $10,000 in our fake portfolio, I might buy $5,000 or $1,000, and I just buy a little bit. And then in another year, I can buy some more. In another year, I can buy some more. But there aren't that many wonderful businesses in Australia. So sure, would I have liked to have bought it for our fake portfolio down here? Yeah, but I haven't had that chance. So I'm going to put it to you, of our $1 million fake news portfolio, should we put $1,000 in this business? A tiny little amount that doesn't really make a difference to our long-term returns because it's such a small position. But should we put $1,000 into it? Let me know. Greg, you come up with a great comment. I'd argue that the very first thing to check out is the board of directors and management team. Greg, I couldn't agree with you more. But you know the reason that people don't go to the board of directors and management team is because it's hard. People are looking for easy answers with their investing. Even the professional investors, they're looking for easy answers. And that's what drives me insane, is because the finance industry has taught us that we should be trying to buy and sell. Why? Because that's how they make their money, when it's not the thing that makes us money. And so when I think about this, I think about, what we should actually be looking at is actually, does the business make sense? Are the people good people? Does it have a good product that people want? Those are the things that I look at. QA, you've said no, we can spend it elsewhere. Good one. Not enough, says Percy. 30K, says Marco. $1,000 is just pissing in the wind, says Stephen. I love this. Kylie, you said 10,000. Greg, you're giving it the thumbs up. Or maybe that was just in response to the thing before, but Greg, good point. Isha, 15,000 clams. Now, we do have a year, according to the rules of the game. We do have a year. $10,000 is 1%, isn't it? Yeah. I think my math is also suggesting the same thing, TC. I'm pretty sure. So 1%. How do you know the management is good or not? That's a good question, Peter. We can come back to that in a sec. Why don't we do this? Why don't we table it for next month? Why don't we say, let's come back to this in a month and see. Let's see what we come back to. So Percy, you've said $10,000, sticky customers, recurring revenues, high profit margins make this very, very valuable. Long-term gain will override the current share price. Peter's saying $5,000. Definitely, I say $5,000, enough to make a difference. Okay, seems like I've been overruled. Okay, $5,000 it is. That's 0.5% of the portfolio. This is a democracy. We're going to put some money in. We're going to spin the wheels. Remember that this is the fake news portfolio. So $5,000, how many shares do we actually get for that? If we put 5,000 clams into this, it's 41. So thank you, Richard. Please do a good job. $5,000 is being added now. Okay. So far we have basically added everything except for Costco, but we can think of this small position in WiseTech as like a starter position. It's a small position and we can build on it in time. We know that it's expensive, but we're going to come back to it again and again and again as months go by. The final thing, and I know I've gone over time, but the final thing I wanted to talk to everyone about is more this part of the portfolio. Now, we are having some fun with our fake news portfolio. It's not the real portfolio. We know this, but we should probably talk about the sensible parts of our portfolio, which are the ETFs and these type of a thing. So PDB, you've said retail investors hardly get the opportunity to see the board of directors, just my opinion. You know what, PDB, I agree with you, but one thing you can do is you can go to the AGM. You can go to the company's annual general meeting or attend online. Most of them offer Zoom, and you can ask questions and you can go and speak to customers, or you can put it on your LinkedIn profile. You can say, hey, everyone, does anyone here know someone that I can talk to in the logistics industry or the freight forwarding industry? I need to understand something about your particular industry. All right, we're going to cover this ETF really quick. Every month, I've said this to you a lot, and we say it on our podcasts, you can go to the ASX website, Google ASX Investment Products Monthly Report. And if you go, you can download as Excel or as a PDF, this report. Not that one. This report, which shows you all of the ETFs in Australia, and it shows you some of the essential information. Now, I've cut out the bit. They break it down into different types of ETFs by like what you're getting. And you can see here the different ETFs. The one that we're looking at is this one right here, the IAF ETF. Might even need to zoom in even more. There we go. This one right here. Now, if you go down this the second column here, what this shows you is the size of the ETF. We covered this a few weeks ago in our show. It's called Funds Under Management, FUM. And if you go down, you can see some of the big ETFs. We've got the BetaShares Active ETF. We've got the IAF ETF. We've got Coupon from BetaShares, which is right here. We've got the Sub D from VanEck, which is here. We've got the VAF ETF, which is here from Vanguard. And there's a few others that aren't shown here. But basically, amongst these, just confirming my quick math, amongst these, this ETF is the biggest. This first column shows you the fee. So it's got a fee of 0.1. That's an annual fee that's taken out automatically from your ETF. This is the biggest ETF. So if you're looking for a reason to narrow in on an ETF, go to this report, go into the different types of or sectors of ETF that you're looking for and see which ones are the biggest. That doesn't mean go and buy them. What it means is just go and see what they do. And so if you then go and see what this ETF does, this ETF invests in bonds, and we don't need to get into that right now. We'll do an educational session on it in the future. But basically, you can use an ETF to invest in so many different things now. Bonds is one of the most popular things to use an ETF for because most people don't buy individual bonds. They buy a basket of bonds. So in here, what we can do, and I've put this, this is the next slide, 2 slides just come from the website. We can see when you look at a bond ETF, there are a few things you want to look at. The first thing you probably want to look at is this thing right here. You want to look at something called the yield, and you can see this here. What this shows you, think of this as a percentage. What this is showing you is basically if all of the bonds that are inside that ETF are just held now for forever, what is the equivalent annual return that I would get between the income that comes from the bonds as well as getting the money back from the bonds in the first place? 4%. If you look over here, this shows you the number of bonds that are inside the ETF. Now, if you and I were to go and buy one of these ETFs, we'd probably have to stump up like, I don't know, 100 grand per bond, but they can buy it in bulk and diversify because they're an ETF and it pulls everyone's money together. This here shows you the annual amount of the kind of dividend payment that comes from the bonds. They call them coupons. This here is expressed as a percentage. And the difference between these key things, you're probably wondering, is why is this one higher than these ones? It's because bonds also mature and they repay their original investors the amount that was lent. That's the bond. My word is my bond. And so this figure includes the income, but also the return of the original bond. So that's why this figure is higher. So when you look at them, you probably want to look at this because this is the more comparable one. But if you're looking for annual dividend payments, you might want to look at one of these or the running yield, more importantly, down here. So I hope everyone has kind of stuck with me so far. Those are kind of the easy bits to understand. The one where people get confused is this one right here. And this is probably the second most important thing to look at. This thing is called duration. Now, you don't really hear that term if you're just investing in stocks. So let me explain what it means. What this effectively tells you is that if interest rates, like say from the RBA or the Federal Reserve in the US, go up 1%, right? What it's saying, if interest rates go up 1%, the value of the bond ETF would fall by 5%. Conversely, if, I'll do a different color, if interest rates fall 1%, the value of this ETF, like the ETF share price, would go up 5.1%. Because remember, they move in different directions. We can explain this another time. But the key reason is this is called duration, and it kind of expresses, it's higher for bond ETFs that have a longer dated bonds, more duration to the bonds. That's why they call it duration. I hope that makes sense. So basically, Aisha, you've just mentioned the next point for me. So if we look here, you can see the first thing we looked at was the yield. This is like the implied return, dividends and the capital being repaid. We looked at these other things, but really, so we went yield, then we looked at like these types of yields, which are different measures of it. We looked at the duration, which is telling us how sensitive the bond is to changes in interest rate. Higher duration, more sensitivity. Because if this number said 10.01, what it would be saying, if interest rates go up 1%, this goes down 10.01%. So higher number, more sensitive. If we come down, we can see the different types of bonds that are inside it. So this is where you're saying, Isha, you can see 50% of the bonds inside this ETF belong to the Australian government. That's who it's been doing it. Government related, this would be like the government of New South Wales, the government of Victoria, government of WA, these types of things. And then we've got corporates. So this might be like Telstra bonds or Apple or Woolworths. You got the point. This other stuff is negligible. So we don't need to worry about that. But basically what's happening, if you invest in this ETF, or if we invest in it in our fake news portfolio, we are loaning money to the government. It's a government bond. And in return, what we're effectively saying is we could get an implied return of 4.17% per year, right? However, if interest rates change like this or like this, the value of the bond ETF will go up and down. So if we look at this bond ETF through time, people say to me, why do we invest in this bond ETF? It looks so bad. That's because during this period right here, interest rates went up. So the bond ETF went down. Remember this? ETF, interest rates went up, bond goes down. That's the simple version. But what happens if interest rates start going down? Would this ETF start going up? That's what the math tells us. So if interest rates start to fall away, if the Reserve Bank of Australia says the economy is in a bad way, we need to start lowering interest rates to help everyone on their mortgages, bond ETF goes up. Now, if you think about this, if you own a term deposit or you're in a savings account, you might get a higher interest rate right now. You might get a higher interest rate, but if interest rates start going down, your savings account and term deposit will pay you less. Whereas the bond ETF, yes, it will pay you less because the new bonds won't be worth as much, but the existing bond portfolio goes up. So it kind of deflects that. So to start this position in our portfolio, I am proposing that we put 100,000 of our fake clams into this ETF because it's one of these ETFs that go in the safe side of our portfolio. So it's in the core and it's in here. And the good thing about it is there tend to be lower risk than shares. So we can always sell it in the future. If shares fall and this one thing goes up, we can rebalance in. So I am going to suggest that we put 100,000 of our fake dollars into this ETF. And as long as I don't have any objections, does anyone object to this marriage to this bond ETF? It does not look like it. So I'm going to suggest that we put 100,000 of our fake clams into this thing. Let's go 102.88, which would be the equivalent of 972 units. Now, for disclosure, QA, you agree. Thank you. For disclosure, we do own this ETF in our portfolios. Again, it's just a disclosure, but you can see in all of the strategies, you can go to our website and see which ETFs we own. Just click on the investment strategy, click the asset allocation, and you can see the ETFs if you want disclosure. I should also add disclosure. Perla is a long-term sponsor of our finance podcast. So is Pocketsmith. They're not paying us to appear here on the live show. What else? I mentioned BetaShares name before. They're a sponsor of our Australian Finance podcast as well, just for disclosure. Cool. Okay. Everyone's kind of in agreement. And there we have it, ladies and gentlemen. Our portfolio has some stocks in it. We didn't put Costco in. Maybe we can review that next month, Percy. I don't know why. But not everything that we propose to put into our fake news portfolio will go in. We did have some suggestions come through about things like MicroStrategy and these types of things. But you can track the fake news portfolio yourself by going to the Rask Media website where you'll find articles, podcasts, that type of a thing. And we can track it in real time. So the way this is going to work going forward with Rask Invest Live, every week you'll find goodies in the show notes. You can see us online on a Thursday. You can invest with Rask, or if you do your own investing portfolio, you could use Perla or whatever type of thing you want to do. We're almost at 30,000 people, almost at 30,000. If you haven't already enrolled in a free course on Rask Education, please go and do that. Tell your friends and family. It is free. We're on a mission to 100,000 people before 2027, and we're already at 30,000. We should get 30,000 this week. Percy, you've said, is the 10% the only defensive part of the portfolio, or are there other parts? Actually, that you raised a very good point, Percy. I need to go back in and adjust something. We added all of these positions to the portfolio, but we didn't imagine that we sold the current position. So we have to put in a sell because we're imagining that we're selling some of our cash. So let's quickly add this up. We have to remove approximately this minus these from the portfolio. So let me just bring this up. These are all just round figures, USD, AUD. So we've got to remove $20,000 of this position and 100,000. So that'd be 120, 150,000, 155,000. We've got to implement a sell decision of 150,000 of the AAA ETF. So 150,000 would be approximately 2,990. We're implementing a sale to fund the purchase of our other trades. So now we can see this. So now our books will be more balanced. If we go back to the portfolio and we see in here, we can see that the books are slightly balanced, still a little bit out of whack. I'll adjust these after the show today. Yeah. So hope that makes sense. Don't forget, you can look at the portfolio online. You can jump into the community. All of the goodies are just below the video. You can tell your friends and family, but we'll be back next Thursday. In 2 weeks' time, we've got Effie Zahos, the fabulous author, the money-saving expert from InvestSmart. Effie Zahos will be joining us live. We have some pretty amazing guests lined up for the Rask Invest live show. So I'll see you next Thursday and the Thursday after that and the Thursday after that. We will be doing one of these portfolio things every month as well. That's on the first Thursday of the month. On the fourth Thursday of every month, we're doing a mailbag segment where you can just come and we'll just talk. It's just question and answers the whole time. So less stuff, more Q&A. So that will be every month as well. So thank you to everyone that joined me today. I'm going to go and try and find a use for this 1.2 kilos of salad topper. I don't know what I'm going to do with all of that, but I hope you have a wonderful day. Don't forget that you can subscribe, enroll in a course, do all that sort of stuff. We're almost at 30,000. That's fantastic. Bye for now. I guess I'll see you next week. Same time, similar place. Have a great week.